Welcome to the Best of US Investors 2025, start of the year. We're so excited. And today we're going to get into what's happening in the markets. Yesterday was big sell-off. Yesterday was the 7th of January. 7 days in, we have big sell-off in some of the Mag 7 positions. We're going to talk a little bit about that, talk about some economics, along with where is this market headed over the next, say, 3 months or so. So let's get this rolling. What's up, Mark? How you
Hey,
doing?
happy New Year. Hope everything
Happy New
went good
Year.
for you. Kind of, I kind of took a little time off over New Year's, came back, then got sick. So I've been trying to fight this cold, and I think I've got it whipped. But if I do a little coughing, that's why. But yeah, it's amazing to me that because of the flip of a calendar, now we're in a new year or a new quarter or whatever. It wipes the slate clean supposedly. But when
Right.
you look at the economics of it and the economic reports and the situation that we're in, it really doesn't. It's just the same under a different year. Okay.
Yes.
So we'll see what happens. We didn't really have the Santa Claus rally that people are looking for. And I don't know how the first, week of or 5 days of trading probably didn't go as well as they thought in January. And then they
Right.
talk about, well, if it's not that, then it's how January goes, it's how the year's going to go. So far, I think we're 0 for 2, and we got one more to go. So we'll see, you know.
Yeah.
Um, and then we've got just to talk a little bit about what's happening out in Los Angeles, which is a huge old fire that has really devastated a lot of people's lives. So we want to think about that a little bit. I know we all have our issues. You have hurricanes down where you are, and I have
Yeah.
tornadoes and blizzards up here, and they have fires and things. And but this is the fire of all fires, and it's going to be quite devastating a long time to fix a lot of this infrastructure and people's houses. And I know a lot of fire insurance policies got canceled in December, so right
Oh,
before
wow.
all of this, and a majority of that's because of the regulations that California puts on their people and on the industry. And basically, they told the industry and the only state I think that does it, that you have to use historical data to repay people back. Well, the pricing and the housing and the cost to replace a house in California is way up. It's not going to be historical, so they would only lose money. So no wonder they canceled. And plus, there's no prevention out there as far as cleaning up brush or any of that kind of stuff. It's just wildfires are ready to roll, and you can see what happens when you don't do it. I feel for
Yeah.
those people, and I hope that and any of our subscribers or viewers are definitely not involved in that. But if you are, I feel for you, and I hope the best for you. So anyway,
Yeah. Well, you used to live there for a while, so
I
that's your
lived,
connection.
yeah, I mean, I lived in San Diego and then Santa Barbara. Santa Barbara's a little closer, but I spent a lot of time, excuse me, on Pacific Coast Highway. I love that area, Malibu and Palos Verdes and well, Pacific Palisades and Sunset. We'd come off Sunset, hit Pacific Coast Highway, and head up to Malibu. There was a place called Gladstone's right on the beach, had seafood and everything, and it's just a great area. So I really feel
It's
bad.
beautiful.
You know, it is,
Yeah.
and now a lot of people are going to have life changing, you know, years to come
Yeah.
because to rebuild, and if you don't have fire insurance, and I mean there were people out with their garden hoses in the middle of this firestorm trying to keep their house wet. I mean it just was impossible. And
Yeah.
but I feel for them. So
Well, and you think about the last, 9 months or so, the amount of, we had hurricane come through here, Florida, North Carolina, big devastation there. Now you've got this California fire thing. you know, insurance costs is going up. It's inevitable. And I think you're going to see more and more states lose insurance carriers. I know we've seen it here in Florida. I know of a handful that have left Florida. Um, and so I think this is probably a rolling trend that we're going to see, and it's just going to put people in a pinch in a sense. Um, I look at what it costs, what my homeowner's insurance went up this year versus the year before. hell, my health insurance cost doubled this year. Craziness.
Well, car
So,
insurance,
huh?
car insurance too. Car
Yeah.
insurance.
So I think these are things that, people aren't factoring into the household economy all that much, and it's putting a strain on them. And now you got a lot of some of the Fed members talking about possibly having to raise rates
Well,
just after
and
they've lowered them 100 basis points.
yeah, I think the bond market's telling us, look, you guys effed up, and you started raising before you hit your target. Same thing that happened in the 70s. And we'll talk a little
Yeah.
bit about that coming up. But yeah, I think, I don't think that we're in the world of buy the dip anymore. I could be wrong, but, we've had 2 years of plus 20% gains in the S&P, and that itself is rare. But to have
Right.
3 years would be even rarer. And we'll go over why that will be here in a few seconds. But anyway, that's
Yeah. Actually, I don't think that's ever happened. Two 20+% or three 20% plus years in a row on the S&P.
I couldn't find it, but I wasn't able to spend much time on it. But you're right, I couldn't find it. I tried.
Yeah. Yeah. So
Okay,
all right. So where do you want to
let
start?
let's talk. Today we had the ADP employment report come out. And there's two things I'm worried about still in this economy, and that is unemployment going up. Okay, people losing jobs, and inflation going up. Okay, and those are the only two mandates of the Federal Reserve. To me, I think they're failing on both, and we're going to find out. But that's my opinion only. So, ADP employment report showed a disappointing addition of just the 122,000 jobs in December. That's worse than the 140 that was expected. It's the lowest since August. And in that report, manufacturing saw the biggest drop in jobs, the seventh monthly decline in manufacturing jobs in the last 8 months. And I'll show you a little chart here. I can share my screen.
Yep. Go ahead.
Oops, hold on. And you can see this is the employment report. You can see what we kind of popped up, into October, and now we've had 3 months in a row. We've been kind of flat. We're not where we were. Here's 2021, okay, right after pandemic. And you can see, you can draw a line basically right this way and see
Yeah.
which direction we're headed. So again, um, let's look at manufacturing. Okay, non-farm payrolls, manufacturing just been in a disaster, and we've been seeing that for a long time. We've been reporting it for over a year. Manufacturing is not doing well, and that's not good for the economy either. So anyway, so there's something in unemployment. We're going to get Friday the non-farm payrolls, which is kind of the joke of data, because if you remember, um, they came out and they do a revision for quarter by quarter. And the last time they did it for the first quarter of 2024, they revised it down 818,000 jobs. Okay. And the next revision for quarter two will be February 7th. And I'm expecting they're going to revise it down a lot for that. And if they revise it the same amount, we basically didn't make any jobs at all. And then if you look into these reports, where we're hiring part-time jobs basically, instead of full-time. So again, it'll come out on Friday. We're going to look at it. We'll talk about it probably on the Zoom call on Friday. Um, but we'll see what happens. But if that report comes out and it's not hot, it's a bad report, it's going to be a problem. So
Yeah.
again, talking about jobs, last Sunday, a report from the Wall Street Journal says it now takes job seekers an average of 6 months to find employment, a month more than in the years past. The number of people unemployed, meaning without a job but trying to find work, is also higher now than it was at the same time last year. That's according to the U.S. Bureau of Labor Statistics' latest employment situation report. The unemployment rate rose from 3.7% in November of 2023 to 4.2% in November of 2024. And we're going to get the unemployment report for December on Friday. You look at how the consumer is doing. Remember, we're a consumer-based economy. 65-70% of our economy in the United States is based on consumer spending. Let's look at credit card defaults. Defaults on credit cards in the U.S. have spiked significantly in the last year, according to a new report. Credit card lenders wrote off $46 billion in seriously delinquent loan balances in the first 9 months of the year, the Financial Times reported. The amount is up 50% from the same period last year and is at its highest level since 2010. Okay, what happened around 2010? The numbers
Right.
indicate that many Americans are struggling to pay off their credit card debt after years of high inflation. And I would struggle to say we're still in high inflation because when you go month to month and your inflation rate goes up, or year over year, month to month, 3%, you're not lowering inflation. You just lowered maybe lowered the amount of increase per month to
The
month or
rate.
year over year. But we've been seeing that being raised the last couple of months. So we'll see what
Yeah.
happens next week with the CPI. Credit card balances have soared in recent years, with the total amount of U.S. consumers owing topping $1 trillion for the first time in 2023. So, I mean, really, if people don't have money, okay, where are we going to get all this growth in the economy because they're maxed out on their credit cards? I mean, people are buying basic necessities such as food and putting their utility bills on their credit cards, and then they're maxed out. So again, I'm
Yeah.
looking at the economy, trying to, you cross the dots, put the dots together, and say, I don't know who's going to be spending if everyone's, kind of out on the edge of the credit cards. Then you see car
Right.
delinquencies are the same thing. Thoughts on that?
Well, yeah. I mean, we were just a friend of ours before Christmas went and needed to turn in her needed to get a new car. She bought a Toyota Sequoia, and I was like, listen, go in there and set your price, and if they can't get the price, start asking for benefits like mats and oil changes and all this, really stick to your price. And we saw her yesterday and she's like, they were very willing to wheel and deal. And if you look at the used car market, that is imploding right now. I mean, you look at Nissan, they're being taken over by Honda. They're in trouble. I mean, I got a Nissan rep from down the road from me who every day sends me an email, sends me a text. I mean, she calls. They're desperate to sell cars right now. So it's a good thing for the consumer if you have money, cash to go buy a car, you can negotiate that. But most people have to finance that. And I think that goes for everything. You
Mm-hmm.
know, we talk about housing every once in a while. We talk about my neighborhood. We still have 4 or 5 homes of the 6 that we talked about a year ago are still on the market. And so, and that's the thing about all this is if the Fed has to raise rates again, think of all the trillions of dollars of debt, housing, commercial real estate, commercial debt, credit cards, everything. And that rate goes up, people are already on the edge of I can't pay it. Can you imagine? So this mistake, in my opinion, of what the Fed has done with lowering rates 100 basis points since what, September, they did it too early. They did it too early. Did it to get somebody elected, in my opinion. It didn't work. Now they're going to have to reverse course, and that hurts. You know,
Yeah, we talked about it a little earlier that if they have to start raising rates, watch out market, because that's, you know,
yeah.
turn out the lights, the party's over, I think. So,
Oh, yeah.
so anyway, other things that concern me, and I know it concerns you too, is our market concentration. Everyone's, in the buy to dip and market only goes up, and for the past 2 years, we've 27, 24% up on the S&P. Well, again, the Wall Street's main index logged stellar gains in 2024, and the benchmark S&P notched its best 2-year run since 1997 and 1998. And I don't know that we've ever done 3 years of 20% So I'll keep looking at it, but I haven't found it. Equity valuations are sitting above their long-term averages, but could be justified if corporate profits stay strong. Earnings per share for S&P companies are projected to rise 10.67% in 2025. Again, I think that's a stretch to me. We've talked about, especially NVIDIA, that although they have, you know, 86% increase in revenue, it was 122% the quarter before and 220% the quarter before. So we're seeing the increase come down. So
Yeah.
it's the law of big numbers. You can't keep going up forever. Uh, and then when you think about what's really driving the market, again, we've talked about this a million times. The top 10 stocks now make up almost 40% of the S&P. Uh, Howard Silverblatt of S&P Dow Jones Indices confirmed this is a modern day record. This level of concentration has pushed diversification, supposedly the bedrock of investment strategies, into myth territory. Torsten Slack, Apollo's chief economist, calls this setup a diversification illusion. On paper, buying into an S&P should mean you're spreading your investment across 500 different companies, but in reality, it's different. It's basically NVIDIA in disguise, he said, and NVIDIA's performance, largely driven by its dominance in AI, is making or breaking portfolios. While NVIDIA gets a lot of attention, this isn't a one-off issue. Two key factors explain this concentration: insane profit growth by mega cap companies over the last decade and their rising valuations. So when you think about that, um, again, it's 7 to 10 companies that are driving this market. And if they ever run dry, and I'll show you some charts, uh, watch out, watch out below. Uh,
Yeah.
and you've talked about it before, again, with the earnings and how they're, can they continue to go on stellar earnings? Who's going to buy this product?
Yeah.
I don't know.
Well, and Jensen Young came out. They had a big NVIDIA presentation, new products, and I don't doubt some of these products. They're building uh, chip or the platform for the Blackwell into laptops. The amount of cool things you're going to be able to do with the products that are creating is immense. But I can't if I'm maxed out, how can I afford a $2,000 to $3,000 computer? How can I get a new gaming unit? I can't. And I think that's where these products are fantastic. They will have their time and they will change how we do work, how we do play, we do all this stuff. But when the consumer is tapped out, and as you talked about credit card delinquencies, most people, that's how they purchase. They're not taking a business loan and, spending a ton of money on, technology. They're more of just they're maxed out. They're just trying to feed their families right now. And I think that's the thing. That's what, could slow down a NVIDIA earnings. You look at third quarter of last year, 2024, there was, NVIDIA did very well, but there was a lot of that was contributed to Elon Musk and Colossus, which is X, which is old Twitter. Their they bought over 100,000 GPUs for which they then linked together, which had never been done, changed the whole game. But think about how many, 100,000 some odd GPUs, they buy them straight from NVIDIA. That's going to bump, NVIDIA's bottom line a bit. Did they have another one of those this past quarter? And I don't think they did. And I think those kind of mega purchases for data centers, things like what Musk is doing with Grok, I think it's called. It's their AI program on X. Those are becoming fewer and fewer as we go quarter to quarter, and that's going to reflect in those earnings. And that's the thing that when analysts expect this price or earnings per share, revenue, what have you, and NVIDIA comes in any lower, even a penny lower, game over. That's the balsa wood bridge across the Grand Canyon that we're walking right now.
Yeah,
And I think you
and
got to be careful.
yeah, and that's what they say. When Nvidia goes, you're going to see, the pins start to fall, and if the top 7 to 10 companies start to wobble, you're going to see the whole index waddle, and you're going to see probably money flow out and back to safety. And we'll talk a little bit about where it might go here in a second. So
Yeah.
you brought up the Fed. The Fed had a lot of talk this week, and I think I'll just read some of what they said. Fed President Thomas Barkin said on Tuesday that the central bank is highly committed to a 2% inflation target, and should price pressures persist, the Fed will need to adopt a tougher stance on interest rates. Okay, so I think price pressures are persisting. I think we're going to see that in the CPI report. I think we're already seeing it in some of the purchasing manager index reports that the prices are gone up, especially in manufacturing and services. Richmond Fed President Thomas, oh, hold on, already did that. San Francisco Fed President Mary Daly said on Saturday that although there has been considerable progress in reducing inflationary pressures over the past 2 years, which I don't think so, inflation remains uncomfortably above our target. In addition, Fed Governor Andrea Kugler, obviously our job is not done. We're not at 2% yet. So we're definitely aiming still to get there. And we know the job is not done. And for me, I'm like, they knew the job wasn't done when they started lowering rates. Why did they start lowering rates before the job was done? So now they've lowered rates. Okay. Treasury yields on the 10 and the 30 have just gone up since the day they started lowering rates. And they only lowered the short-term rates. That's what banks lend each other. It has nothing to do with us, unless
Right.
you are a Treasury bill buyer, which is a 30-day Treasury bill, which we have been. Okay, you've seen that now we're at 4.1%, 4.2%. Meanwhile, yesterday you could have bought a 30-year Treasury bond for 4.91%. Okay, or today we were talking about the 10-year Treasury hit 4.73%. Okay, that's just insanity. And if it hits 5%, we're going to see that higher rates may make fixed income more attractive as an alternative to investors worried about the valuation of the stock market. So the stock market is very valued, and if you look at forward PE ratios and everything, it's going to take you half your lifetime to make your earnings back on some of
Right.
these companies. And so again, if the stock market reverts back to the mean, maybe it's 7%, maybe we have bad years, it's not. And I can make 5% on a 10-year. You know, why would I not? Why would I take that risk and I just put it in a 10-year, at 5% and let the storm go by? What do you
Yeah.
think?
I agree. I think, since September we've seen it move from what 3.2 to 4.7 roughly on the 10 year. Um, that means you've lost money if you've held bonds. You're making it up a little bit on the yield side of it, but when you do, you sort of look at where yields are and you look at where price value, prices on, the top seven or the mag seven. And if you look at the charts, they're not going higher. The mag seven isn't. So that rotation, I think, is happening, has been happening in the institutional world, is they're slowly peeling off their profits and they're rolling into safety. If it's bonds, if it's cash, because they know this can't go higher. These evaluations that these companies have are astronomical. I mean, I saw a forward PE ratio on a AI tech company. It was 156. I mean, I mean that doesn't make sense. Eventually, everything has to revert to the mean. I mean, Jim Simons, who is passed away a couple of years ago, or I think a year ago, um, started. He was a mathematician. Started the company Renaissance Fund, which is the most successful investment fund in history after fees. And his whole premise was everything reverts back to the mean at some point. You look at where these AI stocks are, you look at where really the indexes are, they are so far above their mean, at some point they will revert back. It's just by value. There's no value in AI anymore. Even though it's making revolutionary changes in our lives and in quickly doing it, those valuations just, the market looks at numbers and they want to see those numbers grow. And when they come off, when they're so far off that mean, they'll revert. And I think we're in that phase. We're just looking for the catalyst that triggers it. And I think it's one of the Mag 7 missing. And I don't know who it is, but at some point in the near future, they're gonna. They gotta. They always do.
I think so. Well, I mean, then you toss in all the economic data we talk about, like factory orders came out and they tumbled 0.4% month over month in November. And that's from an upward revised 0.5% in October. And that dragged down orders down 1.9% year over year. And that's the worst since June. Okay. So that's factory orders. Okay.
Yeah.
So I'm trying to look at and connect the dots and what's happening in a macro point of view. And again, the Platinum Channel, we look at technicals, but macro defines market direction and market momentum. We use market direction and market momentum as a tool uh, for trading. So
Hmm.
again, you got to be aware of what's happening. You got to be ready. Even if you're a long-term investor, you should understand what the possibility is coming up here, and so that you don't get rug pulled, which I think is what's going to happen. So,
Yeah.
what do you think?
I agree. I think you have to, use basic investment principles. And I hate the word in trader or investor. I'm just more of like, we're creators of money that will eventually feed, and it doesn't matter what the period of time is. You want to create money, and that's what
I'd say
buying and
create wealth.
selling create
I'd say
wealth.
create wealth because money is a deteriorating asset.
Well, you get what I'm saying. Okay, we'll
Yeah,
go with wealth.
we want to build assets,
Okay.
that increase our wealth.
Yeah. And so you look at it and you go over the last 2 years, you've created a lot of wealth in these, the S&P and the Nasdaq. Okay. Well, everything rotates like seasons. Eventually, you're going to see a rotation out. And I think if you're a long-term wealth creator, you have to look at it and go, okay, now I have to get in preservation mode. And where I've made great returns, say, you know, 40, 50% over the last 2, 3 years, it just holding the index, am I willing to give that up? And the answer is no, you shouldn't be willing to give it up. And that's where you have to risk manage. And you need to start looking at going, where did the money flow into and where did the money flow out of? Because chances are the money that flowed out eventually will become the flow in. And that, in my opinion, is the bond market. Because the yields are so good, because you can buy a 30-year treasury at almost 4 5%, you buy it at 5%, you're getting 5% until it matures in 30 years. I mean, that's a deal right now, and
Well,
it preserves your
that's
capital.
yeah, and it's not like that doesn't increase in value. If we say that 30-year yield at some point the economy rolls back around and then that rate comes back down, let's say the Fed starts raising rates and that 5% on that 30 comes down to 4.5, and you bought it at 5, the value of your bond just increased, okay, by 50 basis points, basically.
Yeah,
So
I, I
you can sell that in the secondary market. Someone's willing to pay you for that yield, that 5% yield, because they can only get 4.5 now. If it goes to
yeah,
4, it's even better. So that's how that bond works.
yeah. And you think about it, is a great deal of money was made in the second half of this past year by people buying the yield, not the bond, the yield on or shorting the bond value uh, since September because yields have gone up from 10 year has gone from say 3.2 in September to where it is today at 4.7 or so. They made money on that. Chances are that somebody's they're going to start doing that on as the yield falls, they'll own the bond, the yield will fall, the bond value will go up. They'll leverage that baby up and they'll make billions of dollars. And yet the retail investor is so naive, they don't look at it that way. They just look at it as bonds are just grandpa's, you know, investment of the, 50s, 60s, and 70s. Whereas I look at it and goes, that's where all the money is. It's the largest market in the world, is the bond market. There is great opportunity. The question is when? When is the best time to start trickling into such a thing?
And
And that's
that just goes back to asset classes. Most people in the retail side, all they look at is stocks, equities. Okay, you got
mhm,
equities, you've got bonds, you've got real estate, you've got fine art. you've got Bitcoin, you've got gold, you've got silver. I mean, there's a lot of value that where money flows back and forth to. Okay.
Yeah,
And we've talked about, if you're just holding your money in cash, you're probably losing 7% a year, 12% a year just in monetary inflation alone, you know.
easily.
So
Yeah,
you've got to move your money to where the value is. The value is in assets right now. So
yeah.
again, don't let inflation take everything away from you.
Well, and I think that's where active wealth management is really key. And we have a society, a society that has been sold to buy and hold. Doesn't mean you exchange investments every day. It's more of when you'll do I where do I you'll I buy value, I profit from it, and then I go find more value and I buy it at a lower price. Why does Warren Buffett had $300 billion sitting in cash plus? He's looking for value, folks. He's made money. Now he's looking for value. So
Yep. Let's look
pound
at
the
a few.
table.
Yeah. Let's look at a few charts here. I just want
All
to show
right.
you, and we'll start off with the S&P daily chart. And you can see even going back here, this is the beginning of October. We've come up and we hit basically a intermediate resistance level. And we just played this all the way through until right before Christmas, okay, on the 18th. And then from that point, we see the 9, which is the short-term uh, moving average. We've just kind of followed it down, and now we're below the 50. Okay, we're below the 20, and now we're hitting right off of basically a support level here. We'll see if this breaks through. Okay, all our oscillators are bad. Okay, or getting bad, but this
Hmm.
is the S&P. So this is the weighted S&P. Okay, so this means
Okay.
that the top 10 stocks are 37% of this. So let's go to the RSP, and this is the equal level, equal weighted S&P. You can see what happened here. What I'm going to
Yeah.
do is I'm going to put in the S&P. Okay, so here's the S&P. So you can see the S&P has actually gone up. This is weighted, so this is more heavily weighted to the mags. If you take it out, you can see what happens. We're just not even close uh, to where the mags would be, and we can even show it even differently here. Let me do the mags, which is the ETF for the mag 7. So if you take, here's the S&P, okay? So you can see how much of a difference the mags make. Look at this. Just took off. I mean, they were about even right back here. And again, beginning of October. And then since then, the S&P really has gone sideways when you compare it to the 7 mag stocks. Okay.
Yeah.
And again, we've come up, we've hit some resistance, and now we're finding some resistance. We're underneath some moving averages. Our oscillators aren't looking very well, even on the mags. So uh, if it weren't for these stocks, we're nowhere, and
Yeah.
um,
If
let's
you
look
go
at
back, just look at just on this chart, look at like 3 years.
3 years.
Can you look at 3 year point of
I
view?
got I got 2 or 5.
Two. Do two. So where's that's the
This is the
S&P.
S&P. These are the mags.
So really it really shows that that concentration in the mags has been a great deal. Could you
Yep.
imagine take that out if you could, what that would look like? That would
Well, I
be
mean, if
wow.
you look at if you look at the S&P,
Yeah.
okay, um, just think if you took, and this was the equal weighted S&P, what it would be. This
Oh
includes,
yeah.
the mags and this is just separate without the S&P, the other 493 dragging down the S&P here, you
Yeah.
know. So you would have been better off back at this time just buying the mags, and staying out of the S&P, basically.
So this brings up a very good a question. Is investing gone from diversify amongst 500 stocks to diversification, or yeah, diversification basically is 10 stocks now.
Well,
Is
it has
that the
been for
world
the,
we're going to live in now?
well, I don't know, but it has been for the last couple of years. Where it goes forward, money always
Yeah,
flows to where the value is, and at some point, like you said, there's going to be some stumbling in some of these mags, maybe,
yeah,
and then where's the money going to flow? Okay, is there going to be a new innovative company that comes up out of the AI world or out of the crypto world or whatever, or out of whatever technology or comes forward, uh, and what happens? So the thing about this, I mean, the S&P for the average investor who just does their 401k and doesn't want to put any time into it is probably the best thing to do. Dollar cost average in. I mean, you can still see it's gone up. Okay.
yeah,
Um, but in order to do the things that we're talking about, you have to put time in. It's not easy and it's not free. Okay.
right.
It's you got to put time in and understand what's going on because you're up against the pros and you're not going to beat them. We are just fighting over the crumbs that they drop, but there's enough crumbs from these big guys that's why we teach what we teach in the Platinum Channel and technical analysis. To when to get in, when to get out. Take your crumbs, and over a period of time, your crumbs turn into big blocks, and then your big blocks turn into bigger blocks.
Absolutely.
Let's look. Let's look at uh, Nvidia compared to the S&P. Oops. Let me get rid of this thing. That thing's kind of screwing up my chart. Remove. There we go. So here's the S&P. Here's Nvidia over the last 2 years. Right about here, May of 2023, you see Nvidia taking off.
Yeah.
Uh, and you see where the S&P is. I mean, so again, what happens if one of these, let's say Nvidia, like we talked about, you know, uh, craps out?
Yeah.
What's that gonna do to the S&P? Okay, what if these guys weren't in it for the last 2 years? What would the S&P look like? Okay,
Way
um,
different.
it would be way different. So again, that doesn't mean anything's bad. That just means that the market is more concentrated in 10 stocks than it has been even before, even more than during the Great Depression. The same thing happened during the Great Depression. A certain amount of stocks gathered the majority of the money. And then when those started crashing, the whole market fell. So just go back in history, be careful, uh, understand what's going on, and teach yourself about the stuff that we learn or we teach, in the Platinum Channel about reading charts, looking at the macro, uh, investment trends, what uh, what company executives are doing, what they're saying. We look at it all, and we try to make inferences about what we see. And now, are we right all the time? No, but at least we think about it more than just having Steve Leisman tell me that the Fed, is going to do this or do that, and everything's fine. It's fine, it's fine. It's like Kevin Bacon in Animal House, when he's like, it's all fine, it's all fine, and he gets run over and he's flat. Okay,
Right.
that's what I think that the press is doing to us right now.
Yeah. Well, and I think the other side is we've been taught for 50 years plus that you buy and hold. And over time, that has worked in a lot of ways. But if you think about the last 25 years, the amount of the volatility we see now in markets, because you think about markets have changed in how they're traded, or they're in, buys and sells happen. Prior to the, 2000s, prior to 19, 95, computerized trading was not prevalent. Today, they make 85, 90% of all trades made today. It's not a guy sitting at a desk anymore. It's a guy watching five monitors, six monitors, and watching the algorithm work. He's just there to make sure it doesn't make a big mistake. Um, and so I think that's something that the dynamics of investing have changed, monetary policy has affected the dynamics of how investing has changed. The
Well, it's
massive amounts of inflated
yeah.
asset growth is insane.
Well, you're absolutely right because we had since the great financial crisis, at 14 years of basically free money. Okay,
Yeah,
and that came to an end a couple years ago, and that Fed raised the Fed rate faster than at any time in history. Okay, now
yeah,
that takes a lag. I mean, when you raise it a quarter point, it usually takes 12 to 18 months to even see that. And we raised it five and a quarter, in a matter of no time. So we're still seeing that go through the economy. And even if they're starting to lower rates, it still takes that 12 to 18 months to get it back out. But what I'm saying is that that free money is gone. Okay. And that's going to affect a lot of companies that rely on free money to operate.
yeah. Okay, so here's a question for you. I have a chart of the 10-year US Treasury yield going back to 1913. I want to put it up here. Um, can you see that? Can you see that?
I can. Yep.
Okay, so when I look at this, so the peak of yields were September 1st, 1981 at 15.75%, which
And
was
we were going through
astronomical.
we were going through high inflation recession then.
Yeah. Are we, in looking at these patterns, what does this mean? Does this tell us anything about where all this is headed?
Well,
Are we, is
what was
this a
happening
setup?
what was
Huh?
happening what was happening back in 80s, early 80s and 81 was we just came out of the Carter administration. We had oil embargoes and we had high inflation. And then in 1980, President Reagan got elected, and that's when you saw this high inflation rate uh, come in, and it's almost uncanny that it's almost the same as what we're seeing today with the Biden
Wow.
transition over to the Trump transition. Not to say that they're apples, but we had higher inflation, same kind of issues going on. We're starting to see
Yeah.
that the yields rise. We'll see what happens, But back
Yeah.
then, interest rates were high. You know, my dad, I remember he was putting money in CDs and rolling them over at 18%. It was great,
Yeah. Well, I look at this and I go, is this portion that we're seeing here, the modern day version of this?
potentially.
You know, does that make sense?
Yeah,
And
because
it
that's what I said. The situations of 1980 are almost the same as what we're going through right now. A new president,
so
new policies.
so does this switch over to a new presidential administration? Does this create, does this, is this period right here equal to what this was? And does that create an opportunity in bonds to capture that value as money begins to flow back out of equities and into safety? Is that, is this, or could we, or is it very possible we'll see higher yields going forward? And for those who don't understand bonds, when they think of it as you and your buddy on a teeter totter, you represent the yield of a bond, your buddy represents the value of the bond. When you
Price,
go
yeah.
up, the value goes down, and vice versa. So what we're seeing is your buddy, you've gone up in value as the yield, but the bond value has gone down. Your buddy's going down. My question is are we going to what would cause the continuation of the yields going higher versus going lower?
It would be a
Um,
higher inflation, I think, and job loss.
so if we see on February 7th a
Because because if I have an economy where I am an investor and I see inflation going higher and people losing their jobs, I know the economy is probably going in the tank, which means that the risk of owning a stock has just increased immensely because companies are not going to be making money, be laying people off. I want to go to safety. and I would go, into a bond. Okay. Until I
Yeah.
saw that reverse. And so what's happening with the Fed, like you said, and I said, I think they made a mistake by lowering rates so quickly. And I think at some point, if inflation comes back, and we'll know more about it next week, we'll know more about employment tomorrow, or not tomorrow, Friday. Uh, if that happens, the possibility is is quite fair that we see rates get raised next year.
Hmm.
And that Powell fell right into the same trap that they did in the 70s.
Interesting. I think, and I ask these questions, we have these talks about this stuff because this is how you should be thinking about creating your wealth. How do I protect it? Number one. And number
Right.
two, where do I go? Where it's like Wayne Gretzky said, I don't skate to where the puck is, I skate to where the puck will be. And that's a similar situation. We saw Kerry has made great moves and has skated to where the puck has been for the last 2 years with AI. Now the question is, okay, where's the puck at? We're at the puck now. Where is it headed now? And I think that's where you and I are just, trying to break down is where is this puck headed? Are we going to see continuation in the AI path, in the technology path, or are we going to see a deviation off that towards safety and towards boring?
So I think
you
it
know?
goes more. I think it goes more about what happens in the macro economy right now, because if we go into a recession, then all bets are off on stocks. I don't care who they are. Okay, if
Yeah,
it's AI or companies or chip makers or whatever, because the demand's going to go down. Okay, when
right.
demand goes down, revenues go down. And if my revenue is at a PE of 193, and all of a
Yeah,
sudden my revenues have dumped, uh, that's not going to be good for the stock. Who's going to invest that at that risk level, at that price in a stock for that PE when during a time of recession?
right. Well, you brought up, since you've been home sick for a while, you've been looking at these corporations and their C-level execs and what are they doing?
Selling.
What they're selling. They're selling. Why would they be selling? Probably because of exactly what we just talked about, and that is evaluations. You know, when you have these massive forward PE ratios, they know they can't keep up with that. So
Well,
what
same
do?
with
They reorganize their holdings. They're risk
that's.
managing their wealth.
I mean, Buffett is following the Buffett indicator, and that's why he's got $326 billion of cash. The market to Buffett is overvalued.
Yeah, yeah. I think, we need to look at it the same way.
I
We
think we
need
need
to
to
take that.
consider it
Yeah,
at least. Yeah.
yeah, yeah, yeah. So, and I think a lot of people who are watching this are a little bit older than 21.
But younger
You
than
know,
Buffett.
they're younger. Well, we're all younger than Buffett right now, but
Yeah.
so yeah, no, I think the theme of the next at least 3 months is know where you stand, know where your wealth is, and consider the next steps. What do you do to preserve capital? Because you've made it. You made a lot in the last 3 years. You know, preserve it.
Well,
So
like Kenny Rogers famously said, you got to know when to hold them and know when to fold them.
that's right. That's right.
Yep.
Well, Mark, you got anything else you want to hit on?
I can barely talk anymore about talk my voice back out. So no, I'm
All
good.
right.
Unless you
All
have
right.
something.
No, I think we hit upon the thing I really wanted to hit upon, and that was look at where we stand. Look at these charts. Go look at a monthly chart of the S&P, the Mag 7. Go look at where they're at, and it's like it's a hockey stick. You're at the top of the hockey stick, or as Raul Paul says, you're at the top of the banana curve, you know? Um, that I think that's where you got to look at it and go, okay, maybe I take a little off the table. Maybe I preserve capital, you know. And Buffett, I mean, if you consider Buffett one of the smartest guys on the planet when it comes to investing, maybe take a cue from him. I mean, we're just two
Well,
regular guys, Mark. We're just two
I
regular
know.
guys.
I know. That's all we are. That's all we have. That's all we'll ever be.
Yeah,
And I'm fine. And I'm fine with that.
exactly. All right. Well, Mark, we'll wrap it up here. hit the like button, the subscribe button for us. Share your comments below. We would like to see, hear your opinion about all this. Also, check us out. If you're not a subscriber to Best of US Investors, go to bestofusinvestors.com or www.bus13.ai. That's our other URL. Go in to our services. We have the Platinum channel, which is Mark and I's we're very active in. And then we have the Gold channel, which is Carrie's flagship offering. And check us out. Take a free trial. We have 14-day free trial going right now. Hit the subscribe button. But always, always risk manage. Always think about where you're at. Position yourself properly. It's my favorite scene in any movie is Brad Pitt in World War Z, and he's in Israel, and they talk about the 10th man. And how did they know there were zombies? Because the 10th man went the opposite direction of the nine who said there were no zombies. And they found out they were, and they risk managed around it. You are the 10th man. Question where you're at, question if it makes any sense, and properly risk manage your investment. So there you have it. Thanks for joining us. We'll see you next week. Have a great time and live loud. See you.
And cut.